Foundations of Real Estate Financial Modeling. Today we're going to be going over a second way of amortizing a loan. Today we're going to be going over the interest-only approach. We're going to go over what that entails, how it's different from a constant payment mortgage, and we're going to wrap it up with a sample problem to demonstrate. So first things first, interest-only amortization. This is a type of mortgage in which a borrower takes out a loan and only pays interest on each period, and then the remaining principal gets paid down at a later date in what is known as a balloon payment or a lump sum payment. And really the biggest implication here would be that since you're not paying down any of the principal on each period, that would mean that you're not gaining any equity on your property over each period, right? So you have $1,000 and you're paying $5 each period on that principal, then you're gaining $5 of equity on every period. But if you're only paying interest, then you're not gaining any equity on your property. That would be useful to show you guys how they would look structure-wise on a table. This is on the green side. We have the constant payment mortgage approach, and you can see you have a constant payment. You got your principal paid, and you get your interest paid. So basically, each period on the CPM amortization schedule, you're basically earning $2,000 of equity on your property. On the right hand side, on the orange table, you can see that since we're not paying principal on each period, we're not making any equity, we're not getting any equity throughout the periods, but rather we're just paying down interest, right? And then at the very end, we just have a balloon payment. Just wrap it up with a simple problem. We have a loan with a principal balance of $2,500 and structured as an interest-only style amortization, having a 6% interest rate. How much will it cost the borrower to pay on interest? Here we go. So the principal would be $2,500. We have an interest of 6%, and we have to figure out how much we're paying on interest per period. So that will be 6% divided by 12. So that will be 0.5%. There we go. So beginning of the period, we have $2,500. Principal paid, we're not gonna pay anything. Interest paid, we're gonna be paying 0.5% on the beginning of our period balance, right? And since we didn't pay any principal, the remaining balance is going to be $2,500. Now, since we're not going to be paying down any principal, we can basically just drag this down to the last period because we know we're going to be paying the balloon payment at the very end. We know we're just going to have $0 until the last period where we're going to pay the whole principal. And the interest, we know that it's basically going to be constant since we're going to have the same interest and the same remaining balance at the beginning of each period. So it's going to be $1,250 each time. Remaining balance is going to be the same. And at the end of period 12, we're going to end up with $0. It's basically this times this, which is $0. If you want to know how much we paid on interest, total interest, and some of this. So we paid $150 on interest. total cost. See our principal paid. Plus our interest paid. And we ended up paying a total of $2,650. And that's it, guys. Super simple. I'm gonna leave the link to a previous video that I did on the constant payment mortgage in the description for this video, so you can reference it if you don't know what that is. And if you guys like this video, please like, comment, and subscribe. If you didn't like it, let me know what I can do better. And see you guys next time. Have a good one. Bye.